That's right, it's Mpc Decision Day here in Nigeria. We await the decision to be announced. The meeting started yesterday. As of now, we have the empty seats at the Central Bank headquarters in Abuja. Our crew have been there since morning, and for now we're waiting the officials led by the central bank governor. I don't know if we could see the pictures of the central bank. There you have it there. Our crew have been there. We're waiting the officials to occupy those seats led by the central bank governor to make the announcement and let us know if we would have a hike in interest rate like other countries, or if it to be retained for the 10th time. Well, back here in the studio, we do have Abdul Kudus Isiaka, economist with ProShare. Abdul Kudus, you were sharing your thoughts, you know, some of the considerations of members. I mean, if you were a little fly on the wall when they're having their conversation, so please do complete it.
Yeah, so I was saying that the CBN has more than one mandate. Although it has a core mandate of price stability, it also has a duty to maintain foreign exchange, to manage foreign exchange. Also, it has to stimulate growth and support, job creation within the economy. So these are, competing objectives that the CBN has to manage. And that's why it's not going to be, an enviable position that those members of the committee are. But, if I want to reason along the lines that those arguing for a hike in rates are thinking, I would be saying that, inflation rate is rising, 90 basis points in April. And then
that was really high.
Yeah, it's the highest in a long time.
Yeah.
It's the highest in a long time. Before then, we saw a 20 basis point rise. Before then, we saw a 10 basis point rise. But then 90 basis point from 15.92 to 16.82. So, it's worrisome. But then again, you don't want to address a supply side issue by hiking rates. The risk is that if you raise the rates, PMI crashes. It's been doing well all along anyway. We've seen manufacturing and non-manufacturing
we're still within
PMI.
50, right?
Yeah, for non-manufacturing PMI, it's been below the 50 index point. But for manufacturing PMI, it's been 50. A little bit, but it's also on the downward slope, suggesting that the economy is expanding. I mean, productivity is, is increasing, but at a reducing rate. So, taking all of this into consideration, you may want to be a bit more cautious about the GDP figures. True, we recorded a 3.11% growth, but then again, we need to know that those figures relate to the first 3 months of the year. And this Russia-Ukraine tension that sent prices soaring didn't kick in until the third month in the quarter.
Yeah, it started by 24th of
the
February.
End of February, exactly.
End of February.
So I think
but we should have captured a bit of it in March.
Just a bit of it. And that's why I would say that I would be able to understand the decision of those arguing for, a hold, just to take a bit more time to see what, how this will play out and what effects it's going to have. But generally, I think the CBN needs to focus on FX issues, You
think that's a major driving factor in Nigeria?
Yes, I think in Nigeria and in other parts of the world as well. In Ghana, we've seen the same trend where the imports of oil, palm oil, imports of gasoline.
Yeah, and Ghana recorded a trade surplus yesterday.
Exactly.
They were able to make a little bit of, at least some use of the surging price.
Absolutely. They recorded a 60% increase in crude oil revenue. But then again, because of a depreciation in their currency and a lot of capital outflows, we've seen them record a balance of payment deficit of 900.
Inflation is really high.
Yeah, 23.6% in Ghana. So, they eventually had to record a balance of payment deficit of $934 million. This is despite the 60% rise in crude oil revenue. So that just tells you, how much capital would flow out of economies. But then again, does that pertain to the Nigerian case? The CBN governor has argued several times, and in fact, an empirical study we conducted at ProShare suggests that capital inflow, outflow in the Nigerian case, and that's why we need to be careful, in the Nigerian case, hasn't typically been a function of interest rate differentials. It's been more of a function of FX rate differentials, and that's the parallel premium, difference between the rates at the two markets. So we're looking at a parallel premium at the moment of around 44 to 45%.
Yeah, I think the gap is... So this brings the question of, it does seem that the Nigerian economy does not respond to what other economies respond to.
Exactly.
At a time when inflation and, all of that is affecting, for instance, the equities.
Exactly.
Nigeria's equity
was strong.
It's just taking a breather now.
Yeah.
So how do we describe the Nigerian economy? Because the truth is, if we cannot predict it or we cannot capture the factors that affect it, it might be difficult to direct growth and development.
Yeah. Absolutely, I agree with you. The Nigerian economy is quite peculiar. You may want to say it's different from the rest, but I think it's because of some fundamental issues, structural issues. Nigeria has a peculiar issue with security, which is a disincentive for any investor. So hike rates all you may, it's not likely to attract investment, FPI or FDI. So that is at the base of it. And, there are other logistical issues, cargo clearing logistics at the ports. The ETO, the Economists system is more or less, non-existent anymore. You also have issues with security of lives and property. You also have issues with transport, inefficient transport. So, again, we could take the whole day to talk about some of these structural issues, but I'm kind of concerned about what the topic of the discussion is.
Yeah.
Because transportation, for example, you don't want to set up rail lines off the regular transportation grid. We don't see that connectivity. In other places where you have transportation, which is supposed to reduce costs of moving items from farms to the market, and also to be able to improve, the pace at which people can walk in remote areas and, walk in the metropolis and live in remote areas. You want to connect, exactly, you want to connect the different modes of transportation. You are not just, exactly, so you don't want transport, you don't want railway lines in remote areas or along remote that make them very vulnerable. So, susceptible to attacks, and that's what we are seeing. Again, the security infrastructure is also an issue. So we could go on, and I think...
some people watching might ask that, I mean, I've gotten this question a lot, especially because in recent times, I mean, if it is retained, if rates are retained this time, it will be the 10th time it's retained. And people ask, what is the essence? How does it concern me as a manufacturer, as an airline operator, or airline agency, as a mini trader out there? What's my business with the MPC? Why should I care?
Okay. Well, obviously, inflation is a big problem, and one of the major objectives of the MPC, setting the MPR, is to determine, the rate at which, base rate at which lending is done within the economy. So it does affect the cost of funds within the economy, basically. So we could likely see, if rates go up, other rates within the economy because of the yield curve, we could see other rates also rise, But aside that, there are concerns about raising rates, borrowing costs, and the possibility that
because the MPR is the interest rate that determines how much you pay as interest rate if you go to a bank.
Yes, but that's between the central bank and the government. So
then there's a CRR.
Yes, there's a CRR. So the CRR, which currently is about 27.5%, is that is the part of deposits that banks need to hold with it's a statutory requirement that banks need to hold with the CBN. It's also actually at a zero interest rate. We could have a lengthy discussion about that because it's been widely criticized that at that rate it's actually a disincentive. Exactly, 27.5%. There's also a statutory liquidity ratio that is that portion of their deposits, banks' deposits that they must hold. So if you add the two together, you're looking at something in the range of 67% of their deposits that they can advance as loans.
So you now have less.
Exactly, to advance as loans.
Loans, for private sector, for, business people who want to. And this will make it more difficult.
Exactly.
Although people will argue that, I mean, really, with the interest rates at the level that it is, how much of that goes to private sector trading or development or manufacturers? How much of them, or what percentage of them actually depend on the banks for funding? with the bureaucracy and, you know, the interest rate?
Well, I'm certain that, you know, manufacturers, you know, and importers still would approach banks, no matter how little, to get some facilities. And it would definitely be one thing, a major, you know, factor that would determine what their bottom line is at the end of the day, what revenue, what profit they make at the end of the day, because interest cost is a major, or what you call finance cost, is a major line item for many of these businesses. So it's going to be crucial. But aside that, I think one more thing is, you know, raising rates sometimes is aimed towards, you know, trying to attract capital from abroad. I think we discussed that a little bit just now. But, you know, if we're able to raise rates and we're able to attract more capital, then the Naira appreciates. So there's kind of a transmission mechanism there. If the Naira appreciates, then we could actually see, you know, importers be able to, you know, importers are able to, well, an appreciation of the Naira actually may be not so good for exporters, because then it's a disincentive for, you know, your trading partners. But overall, an appreciation in the Naira means that importers are able to import at a lower cost. So there's that benefit on the one side, but then there's a trade-off. So overall, I would say that, you know, there are reasons why we need to be interested in the MPC, aside from just, you know, curtailing inflation and possibly controlling money supply growth and possibly increasing capital importation. It also could possibly have implications for productivity. If we see a jack in rates, you know, something similar to what the, you know, the the central bank, Federal Reserve did, 50 basis points, you know, it could have a negative impact on productivity and even the output of the economy. We saw the U.S. economy contract by 1.4%.
Yes.
Yeah, in Q1. And
I think 40-year high. I mean, inflation in US, UK is about 40-year, 30-year.
Yeah, in the US it's a 40-year high.
And they are talking of recession now.
Yes, yes, exactly. That's the point I was making. That you're seeing a raise in rates consistent with, you know, a contraction in the economy. That's it kind of suggests that, you know, you don't address every inflationary problem with a raise in rates.
And they have promised that, I mean, they're going to keep raising rates until inflation is dealt with.
Yes, yes, and that's quite similar to what Paul Volcker did in the 70s when, you know, he just kept on raising rates by about 50 basis points. So there's this joke that they've coined in the US where he said Jerome Powell is wearing the Volcker suit and is ready to keep raising rates. But I think that that's due majorly to, you know, approval ratings, which is non-existent around here. You know, if you add approval ratings and the government is a bit more concerned about how it looks before the populace, then maybe, you know, we'll be a bit more concerned. The MPC will be more, you know, motivated.
We have it here. We don't have approval ratings. I mean, sentimentally.
Well, they don't feature politicking, and political process is more of, you know, through political machinery, not so much of how the populace perceive them.
Okay, all right. Just we would like to remind our viewers that our crew are already there at the CBN headquarters in Abuja. We are waiting the decision of the MPC. They started their meeting yesterday, and we expect for them to announce their decision today. In fact, the meeting was supposed to be for 11 a.m. That is why we had to have a special edition of Business Incorporated. Subsequently, you have those programs that you have always been looking forward to, especially we have Political Paradigm, and the guest there is the governor of Ekiti State, Governor Kaide Fayemi. He's a guest on Political Paradigm. He'll be featured immediately after the announcement of the MPC, so do stay on Channels Television. We'll certainly give you what's current and what's going on even in the corners. That's what we do here. And, you know, that brings the conversation to the area of politics. I think one of the countries there, it's a pre-election year.
Yeah.
And that normally has its own impact. In fact, some people believe that the devaluing of the Naira we've seen in recent weeks is because of political activities. I don't know what you think about that.
Well, it's possible. In fact, it's very likely. We've seen money supply grow tremendously, as I mentioned just now, tremendously in recent times. And I think it's related to, the political spending. We'll see more of that in months to come, actually. And that really should give us concerns about, the inflationary trends to expect going forward. But then again, as I mentioned, the CBN has other instruments to handle such a problem.
Are they efficient?
Well, I think they are efficient if they are well utilized. They could deploy. They could definitely deploy them more efficiently. But I think that rather than jack up the rates by 50 basis points or 25 basis points, where we're still trying to gain clarity about where the Ukraine tension is headed and the energy cost issues that have attended that, as well as the other issues we already discussed. I would rather say that they should exercise a bit more caution and not be too optimistic on the back of the real GDP figures we recorded in the first quarter of the year. And we've had 1 or 2 months afterwards.
Even the GDP figures, quarter to quarter, was negative.
Yes, so
it's not year on year.
Exactly.
I think a more realistic one would be quarter to quarter.
Yeah.
Even though some economists have said, it's expected because at the end of the year, which is the fourth quarter, it's a blooming year, a lot of spending and all that. And then the first quarter is normally the planting season. Exactly. So normally a lot of things are squeezed.
Absolutely. I agree with that. And, it's quite like what was actually recorded in the UK too. So the UK also decided to raise rates to about 25 basis points recently. And you saw on a quarter-on-quarter basis, they recorded a 0.9% growth. But on a month-on-month basis, they recorded a minus 0.1% growth. So I would rather, pay attention to the much more, short-term index rather than look at, over that longer period of time. So on a year-on-year basis, fine, we recorded a 3.11% growth. But if we recorded a negative real GDP growth on a quarter-on-quarter basis, it sent a signal in spite of the analysis you gave.
All right, Abdul Kudus, we'll just have to take a break now. When we come back from that break, we're still here, and we're having more conversations as we await the announcement of the Mpc decision for the month of May. Well, Abdul Kudus thinks that it will still be a hold rate. That'll be the 10th one for the Mpc since September 2020. But there are others who believe that with inflationary pressures and with the spreading effects of what's going on in Ukraine, we might actually see a hike in interest rate. But, we'll see that. We'll have all of that here on this special edition of Business and Corporate Extended Edition, I would say, where we await the decision of the Mpc. Just stay with us. It's Mpc Decision Day. We await the announcement of the Mpc for the month of May. And we do see there a couple of the officials taking their seats, but we have not seen the central bank governor who will make the announcement to tell us what they have decided, how they have decided to run the country, the parameters they have decided to run the country by for the next 2 months until the next meeting. It's Mpc Decision Day, and we are awaiting the announcement of the Mpc for the month of May. So while we wait, we talk, and what we talk about is expectations. We now have Mr. Paul Alaje. He's a senior economist and partner at SPM Professionals. He joins us from Ibadan. He would have been here in the studio, but had to be in Ibadan, so he joins us virtually to also contribute to the conversation. Good morning, Mr. Alaje. Good to have you.
Good morning, and thank you so very much for having me.
Great. So what's your own forecast? Do you think that the parameters will be retained again, or do you see a shift in ground?
Well, parameters, mentioning what my forecast will really be very tough now, because we have quite a number of things that we are dealing with as a nation. Some of those are endogenous and others are exogenous. Among exogenous variable is what you rightly mentioned, the war on Ukraine by Russia, which definitely has added to prices. We've seen the major surge in cost of wheat in Nigeria as a result of crisis going on between Russia and Ukraine. All of these had major, tremendous implication on prices because of factors that are not just monetary nature, because of trade factor as well as fiscal factor. We've seen inflation continue to grow. And one of the things Monetary Authority, in this case, Monetary Policy Committee and the Central Bank of Nigeria have mandate to control is price. We call it price stability and FX stability. So we have seen increase in price, which we might not necessarily trace to the fault of monetary authority. But you know, that is on one side. On the second side, we have exchange rate instability. One of the reasons why we have reduction in the value of GDP that was recently released by the National Bureau of Statistics is because we need to find the real GDP figure from the nominal figure. And when that happens, we have to see what the inflation is saying, which will later determine whether we are doing well or not. Again, it's always good to give our GDP figure in dollars. And when you look at what dollar was last year and what it is today, it certainly will have tremendous negative impact on what the GDP figure should be. So what should we do? Should we therefore increase rate? If we increase rate, it is expected that in near term, we might see a reduction in MPC and we might see a reduction in inflation if NPR is increased. But what happens to inflation? What happens to unemployment? Unemployment may, and I dare say, is expected to increase. Already, last figure shared by the National Bureau of Statistics shows the unemployment figure is at 33.1%. Do we want more people to be jobless if we increase rate? What if we reduce rate? Inflation will go gaga. Already it's high. It may go above the roof. That is not what Monetary Policy Committee wants to see. Now we need to choose between the devil and the deep blue sea, or we stay in our homes by sitting on the fence. Several options, three major options before the central bank, a governor and his team, the Monetary Policy Committee. But what they continue to do is to sit on the fence, not to increase rate or reduce rate, but maybe adjust all other factors, which may include cash reserve requirement or cash reserve ratio, among the other factors that could be adjusted. What I see, if there will be any change at all, it will be more convenient to look at adjusting other parameter rather than adjusting monetary policy rate this moment today.
Yeah, so Mr. Laje, it's good you connected it to unemployment because we're having the conversation as to how relevant is it? How does it really impact me? How does it impact if CRR or NPR is hiked or is retained? Really doesn't make any difference.
Well, it does. It makes a lot of difference. That is why Monetary Policy Committee, they take critical role in our economy. As a matter of fact, every economy sits on three legs. The fiscal, which is, of course, government income and expenditure. That's where you see Ministry of Finance, you see Ministry of Budget and National Planning, and so on. You also have Trade Ministry, where you have Ministry of Trade and Investments, things that we export, we import, what is our trade balance like, and most importantly, you have monetary authority, in this case, the Central Bank of Nigeria and the Monetary Policy Committee. So it's very important. If rates are increased, what happens is that you are going to be seeing increase in T-bills, in bonds. Most commercial banks and other financial institutions, including that of pensions, will find it convenient to give their money directly to government rather than giving it to investors to start businesses or grow businesses and employ more people. With high rates, payments will be given to government rather than going to the hands of private sector at lower rates, because it will become more expensive for private sector to access funds. When they cannot access funds at cheaper rates, what will happen is unemployment will grow. Already, we are dealing with insecurity. When unemployment and insecurity have handshakes, then nobody is safe.
And then Abdul Kudus here in the studio was talking about the role of FX. You know, in all of this, that's one of the drivers of inflation in Nigeria seem to be the foreign exchange. That seems to be either the supply is not sufficient or is not accessible. You know, what's your own perspective to that?
Well, FX FX plays significant role. When you look at the National Bureau of Statistics import bills for Nigeria, we have over 80% or 90% of our import is it's on manufactured goods, almost finished goods. We have even those who are importing for the purpose of manufacturing in Nigeria. FX is not completely available to them, even if you want to pay school fees and so on and so forth. It may take time. But to be fair on the Central Bank or Monetary Policy Committee, they cannot print US dollars or any foreign currency. They have to deal with the amount we can generate either as receipt from crude oil or Nigerians that are living abroad that are coming home, that are sending revenue home. So FX plays significant role. And when you look at what it has been, even at official window, it has continued to be emaciated. That on one hand. There are other factors responsible for inflation, insecurity, especially food inflation. When you look at the report shared by the National Bureau of Statistics, about 18% is food inflation, while inflation is here around 16%. Why do we have food inflation more? Because more and more people that are supposed to farm, especially in the areas like Kaduna, Borno, and so many other states, have been affected. Even though we have seen a lot of effort by Nigerian military, by the federal government and some state government, trying to resettle people and putting confidence in the mind of Nigerians who are majorly farmers to go back to their previous home so that they can continue their activity. These are things that government has done, by the way, and we must acknowledge. But that is still not sufficient because food inflation is high. The last but not the least is transport. Moving from one area to the other, we have some areas like Benue where we still have a lot of output, like Jos where we have a lot of output, in Plateau State, I beg your pardon, in Niger State and so on and so forth. But what is the quality of road? How accessible are these produce that we have in abundant supply in rural community? How are we able to access them in urban center? A major thing we need to do is so logistics or transport on one hand, insecurity on the other hand, and we have inflation, and we have FX differences which continue to be devalued from time to time, also having a lot to do with inflation. So if you ask me, is it just monetary reasons why we continue to have our inflation? My answer will be no, because we have fiscal reasons why inflation continues to go up, and we also have trade reasons. But monetary authority, of course, because it's a core mandate, they will have to find a solution to all of those things that are making inflation to go up. And don't be surprised when you start seeing central bank governor among other agencies of government giving advice, strong advice in strong tone to other agencies of government on what they think they should do in order for the three legs of economy to cover. And that is why I've said that even though we are seeing the central bank governor, Minister of Finance, Minister of Trade talking together, it does not mean they are communicating. Communicating is when your policies converge, and we are seeing progress in terms of policy that can touch life and destinies of many Nigerians.
All right, Mr. Laje, we see there on the screen that the central bank governor is out and he's preparing. We do know that in a couple of minutes, he will be set to make that announcement. But while we wait for that, Mr. Laje, the central bank has had a lot of policies, plans. One of them is the RC200 to boost the supply of FX, to attract more remittances. You know, are these policies, are we feeling the impact?
Well, not sufficiently, not as effective as we should feel them. This is because most of the policy made by central bank or that of Monetary Policy Committee is mostly executed and enforced by central bank. Unfortunately, economy is larger than central bank. We need an inclusion. We need that involvement coming from Ministry of Trade. When you talk about FX, trade must be present. It must be visible. We must see that encouragement coming from authority, especially the Ministry of Trade and Investment, working with central bank on this.
All right, Mr. Laje, thank you so much. We do hope you can hold on. The central bank governor is briefing now, so we'll listen to that decision and then we'll be back.
These developments partly reflect the aftermath of the ongoing war in Ukraine, the backlash from the numerous sanctions imposed on Russia by major advanced economies, as well as persistent supply chain disruptions in major trading routes. At the same time, the Chinese economy remained confronted with the lingering impact of the COVID-19 pandemic, total lockdown of major cities, significant distortions in property market, and modest inflationary pressures. Consequently, the advanced economy and emerging market economy central banks alike are switching to monetary policy tightening to curb the sharp rise in inflation globally. Even as global output growth recovery moderates, the domestic economy is expected to remain on the current path of recovery through 2022. This is hinged on the continued impact of stimulus by both the monetary and fiscal authorities to support the economy following the outbreak of COVID-19 pandemic, and the committee assessed these developments and the outlook for the rest of the year. 11 members of the committee attended this meeting. The global economic development. The global output commenced a broad slowdown in the first quarter of 2022 as a result of the conflict between Russia and Ukraine, after recovering considerably in 2021. This led to massive supply constraints, with the backlash of sanctions against Russia creating huge macroeconomic imbalances for several countries. Consequently, the uncertainties that have arisen are buoyed by the resumption of the spread of the COVID-19 pandemic in China, a key hub of global manufacturing. This has given rise to upside risks to inflation and downside risks to growth. In addition, the huge amount of stimulus deployed by various countries to ease the downsides of the COVID-19 pandemic, particularly in 2021, has predisposed the global economy to huge debt levels, considering the current burgeoning global private and public debt portfolios. Central banks in both the advanced and emerging market economies have thus commenced monetary policy tightening to curb rising prices. These could impact the recovery negatively and result in a rise in debt default as global financial conditions indeed get tighter. Furthermore, China has also reintroduced constraining measures to mitigate the spread of a new wave of COVID-19 pandemic within its major industrial cities, resulting in a slowdown in production. In the light of these headwinds, the International Monetary Fund (IMF) downgraded its forecast for global output growth for 2022 and 2023 to 3.6% apiece from 4.4% and 3.8% respectively, reflecting the severity of setbacks to the global recovery. Inflation continued to rise unabated across several advanced economies and is projected for healthcare projects under the Healthcare Sector Intervention Facility, bringing the cumulative disbursements to 130.49 billion naira for 126 projects comprising 58 hospitals, 31 pharmaceuticals, and 37 other healthcare services. The bank released a sum of 21 billion under the Export Facilitation Initiative, EFI, for 3 projects in domestic production and value addition of cocoa and sesame seed. This intervention is targeted at further expansion of the economy's non-oil sector, non-oil export basket, towards improving foreign exchange revenue earnings for the country. To support micro, small, and medium enterprises, the bank disbursed 1.5 billion to 2,718 new projects through the Agribusiness Small and Medium Enterprise Investment Scheme (AXMIS) for activities in fish farming, rice processing, wheat farming, poultry farming, livestock farming, ICT, and tailoring, among others. This brings the cumulative disbursement under the AXMIS to 136.13 billion naira. Under the Micro, Small, and Medium Enterprise Scheme, the bank disbursed 2.7 billion to support youths engaged at various nodes of the agricultural value chain, bringing the total disbursement under this intervention to 98.88 billion naira to 749 MSME projects across the country. In the area of energy and infrastructure, the CBN released 15.71 billion to power sector players, including generating companies and gas companies. Under the Nigerian Bulk Electricity Trading PLC, NBET path, bringing cumulative disbursement under the facility to 1.3 trillion naira. The sum of 22.67 billion was also released to distribution companies for their operational expenditure and capital expenditure under the Nigerian Electricity Market Stabilization Facility Phase 2. Cumulative disbursement under this scheme currently stands at 251.93 billion naira. Additionally, under the National Mass Metering Program, the bank has disbursed 0.19 billion naira to DISCOs for the procurement of electricity meters, bringing the cumulative disbursement for the procurement and installation of 865,956 electricity meters across the country to 47.82 billion naira. Interventions in the energy and infrastructure are designed to improve investment and develop enabling infrastructure in Nigerian electricity supply industry. Our outlook. The broad outlook for both the global and domestic economies in the medium term remain clouded with uncertainties arising from the lingering war between Russia and Ukraine, the unfolding impact of the extensive sanctions imposed by several countries on Russia, and the downside risks from the continued spread of COVID-19 pandemic. Global growth is thus confronted with significant headwinds, which may derail the current projection further. The persistent rise in inflation is also set to undermine the recovery of output growth due to the associated buildup of uncertainties around the cost of inventory and other production inputs. The rise in global debt is also an unfolding dilemma which policymakers must carefully evaluate and address to avert a near-term global financial crisis. In summary, while global aggregate demand remains strong and growing, the numerous supply-side constraints will continue to undermine the recovery effort, at least in the short to medium term. In the domestic economy, data on key macroeconomic variables indicate that the recovery of output growth will continue, but at a much subdued pace, considering the unfolding domestic and external shocks to our economy. Domestic price development is, however, expected to maintain an upward pressure in the light of the buildup of increased spending related to the 2023 general elections. Consequently, the Nigerian economy is forecast to grow by 3.24% by the CBN estimate, 4.2% Federal Government of Nigeria estimate, and 3.4% IMF estimate. The committee's consideration. At this meeting, the MPC noted the risks confronting the global economy as those associated with not only inflation and prices, but also include risks associated with weakening growth prospects across the world. The committee observed that whereas post-pandemic policy support has remained broadly expansionary, at least from a fiscal standpoint, the sharp rise in inflation across both the advanced and emerging market economies has generated growing concern among central banks as the progressive rise in inflation, driven by rising aggregate demand and wage growth, is putting unsustainable upward pressure on price levels. Consequently, the major central banks such as the US Fed, the Bank of England, European central banks, and the Bank of Canada have provided strong guidance of a progressive shift away from monetary policy accommodation to drive market interest rate upwards, which may ultimately impart capital flows away from emerging market economies. On another hand, MPC noted that the war between Russia and Ukraine has resulted in significant disruptions to the global supply chain at a time that the global economy is still confronted with downside risks to growth associated with post-COVID-19 pandemic. In addition to this, global trade has been impacted by the series of restrictions imposed by NATO countries and its allies against trade with Russia. This has increasingly fragmented the global economy, imposing huge restraints on the tepid post-pandemic recovery. Only recently, China, US, and South Africa are seeing renewed spike in COVID-19 infections. For instance, the Chinese government recently reintroduced lockdown in major industrial cities to forestall the spread of the pandemic, further disrupting the supply chain crisis. In the view of the MPC, these two risks pose great challenges to rising inflation globally. As for our domestic economy, MPC noted with delight that the GDP grew by 3.11% in the first quarter of 2022 year-on-year, highlighting a steady recovery for the fifth consecutive quarter. Quarter-on-quarter, real GDP grew by 9.36%, a slight moderation from 11.07% during the previous quarter. MPC, however, was concerned about the somewhat aggressive rise in inflation by almost 90 basis points in April of 2022. To dampen the expectation of the inflationary pressure, MPC decided on the need to take a shift from its historically cautious approach on interest rate to a policy rate hike while still adopting an accommodative approach to development finance initiatives that have helped historically the growth of the Nigerian economy and sustained a recovery. MPC is of the view that rates on the development finance initiatives of the CBN should remain at 5% at least till March 2023. Consequently, as regards the decision on whether to hold, tighten, or loosen, MPC feels that loosening in the face of rising policy rates in advanced economies may result in sharp rise in capital outflow and faster dry up of foreign credit lines. MPC also feels that loosening could lead to further liquidity surfeit and inflationary pressures. As to whether to hold, MPC feels that this will strengthen the perception that CBN has abandoned its primary mandate of taming inflation. On the need to tighten, MPC feels compelled that tightening would help moderate the inflationary trade-off from the steady growth recovery so far recorded and improve real GDP. MPC also feels that tightening will help rein in inflation before it assumes a galloping trend, considering the progressive increase in headline inflation month on month, particularly with the sharp 90 basis points increase recorded in April of 2022. Furthermore, MPC feels that tightening would narrow the negative real interest rate margin, improve market sentiment, and restore investors' confidence. Equally, members believe tightening would moderate inflationary pressure, pass through to exchange rate depreciation, and moderate the speed of capital flow reversal, provide incentives for foreign capital inflows, and sustain remittances. Lastly, tightening could moderate government more domestic borrowing as government debt servicing to revenue ratio increased significantly in recent times and threatening debt sustainability. The committee's decision. Members expressed deep concern about the continued uptrend of inflationary pressure. Despite the gradual improvement in output growth, the committee noted that the current rise in inflation may be inimical to growth and thus hinder the full recovery of the Nigerian economy. While MPC identifies several supply-side factors which may be contributing to inflationary pressure, emerging evidence shows that money demand pressure is on the rise and is unlikely to abate until the 2020 general elections are over. The dilemma confronting the monetary policy at this meeting, therefore, is how best to drive down domestic prices, in this case inflation, while at the same time continue to support the fragile recovery of the Nigerian economy. In the light of the current circumstance, the committee was of the view that it was confronted with the choice of either to hold all policy parameters constant, to allow previous policy measures continue to support growth, or tighten the stance of policy to curb money demand growth and development of its domestic prices. A loosening option would likely result in an increased liquidity surfeit, rise in inflationary pressure, and further pressure on our exchange rate. The choice of holding, in the view of members, would not only continue to support growth, even though moderately, but will also allow the growth of money's demand to continue at the current pace, leading to the uptick inflationary pressure. While growth concerns remain paramount to the committee, the persistent uptick in domestic price levels is clearly a downside risk to growth that must be taken on immediately. While it may seem contradictory to raise rates in the face of fragile growth, it is a dilemma that most central banks around the world today are grappling with at this time. Yet, on balance, it is quite clear and compelling that tackling inflation is more urgent in the sequence of policy objectives. In this regard, MPC urged the bank to redouble its efforts at supporting the priority growth-enhancing sectors of the economy, while urging the federal government to do more to provide a safe and secure environment for economic agents to boost activities and eventually stimulate growth. After carefully reviewing the developments of the last 2 months and outlook for both the domestic and global economies, as well as the benefits and downsides of each policy option, the committee decided to raise monetary policy rate, the first in 2.5 years, to rein in the current rise in inflation, as members were of the view that the continued uptrend may adversely impact growth. The bank further reaffirmed its commitment to continue to provide support to priority sectors as the need arises to support growth until the current upward pressure in price development abates. The committee therefore decided by unanimous vote to raise the monetary policy rate. 6 members voted to raise the MPR by 150 basis points, 4 members by 100 basis points, and 1 member by 50 basis points to 13.5%. In summary, MPC voted to 1. Raise MPR to 13%, 2. Retain a symmetric corridor of plus 100 and minus 700 basis points around the MPR, retain the CRR at 27%, but also urged the management to continue to use its discretionary powers to mop up liquidity where they find it, to ensure that we maintain a very tight monetary liquidity in the system. And 4, retain liquidity ratio at 30%. I thank you all for your attention.
Thank you, Governor. And that was the 142 communique of the MPC meeting held 23rd to 24th of May 2022. We will take some questions, but you will observe, gentlemen of the press, that we dropped the time for these MPC from 2 to 12 due to some exigencies. And so I will appeal and also apologize up front that we may not be able to take all of your questions. The same for our friends who are also online. We probably will not be able to take all of your questions. And so keep it simple and straight to the point. Thank you.
Thank you, Director. Good afternoon, Governor and members of the MPC. I just have one question. The historic change to the MPR, first time in 2 years. Why is the MPC deciding to alter the rates now? Is it more of a local environment, or you're following global central banks? Thank you, Governor.
Good afternoon, CBN Governor. My name is Issa Abdullah from the Telegraph newspapers. Nigerians of late have been witnessing acceleration in market price and inflation. What will MPC do to rein in inflation? And secondly, the increase in the lending rates, what impact will it have on GDP?
Governor, members of the committee, my name is Sunday Michael Ogo. I write for Daily Trust. Recently, we learned that JP Morgan had delisted Nigeria from the emerging market list, especially at a time where we need all the dollars available to support our local situation. What is your reaction to this development? Thank you.
Thank you. That's the much we can take. Governor, sir.
Well, thank you very much. I think for me, the easier one will be the issue of JP Morgan that were delisted. Let me say that contrary to widespread media reports, that Nigeria has not, reports have it that we were delisted or that we were removed from the JP Morgan bond index. And the truth is that that is very untrue. Nigeria is still in the index. We were only reclassified. Nigeria's rating, I would say, was reclassified from overweight to market weight, which is just a mere reclassification of our size in the index, akin to a rating agency changing your outlook from maybe positive to stable. This is basically what has happened. So let me say, I repeat, Nigeria has not been deleted from any JP Morgan bond index. We have the report here, page 10 of it. I won't bore you with it. Those of you can go online. You can go online and read it. Page 10 was specifically devoted to Nigeria, and it was very, very clear the reason why Nigeria's rating was moved from overweight to just market weight. I don't think it is important for me to say what they said. If you read the report yourself, you will see that it is not as a result of certain failure or failings on the part of the Central Bank of Nigeria. What is important is that, at least one thing that they have said very clearly, is that Nigeria had been left as an overweight country because they felt that as an oil-producing country, accretion to reserve in the midst of an increase in crude price should result in accretion in reserve. And since they are seeing that this is not happening, that is the reason Nigeria's weight has been brought from overweight to market weight. But I think the other details are there in the report. The other questions from Nancy and New Telegraph are basically related to the main reasons for today's meeting. On inflation, MPR, why the central bank decided, after almost about 2.5 years, to change its stance from just being somewhat accommodative by saying that, yes, we want to play soft because we're trying to see a gradual moderation in inflation rates, while at the same time we see to have global rise inflation and price levels. You all would have seen that the price of crude quite unexpectedly has been at above $100 per barrel. In fact, Nigeria's Bonny Light as at yesterday when we started the meeting was about $116 per barrel. And what this means is that the basic plot, what is called the standard pricing indicator, means that, yes, whereas crude prices have gone up per barrel, but at the same time, the cost of refinery and ultimate price of the product at the pump is at the station, the pump price at the station will naturally have gone up. This is a global phenomenon. And I was watching CNN a few days ago, and one of the analysts was talking about an incredible distortion to financial markets in the United States. And I said, yes, well, welcome to a situation whereas inflation is rising to unprecedented levels in the US and other economies, growth is also coming down. And if you must tackle inflation, prices, and at the same time you want growth, then you know that you are faced with some compelling dilemma as to what to do. You like to see inflation come down, but at the same time, you want growth to go up. But to achieve this, you have to take decisions that are in opposite direction. And that brings to bear as to what type of skills do you have you put in place to ensure that you're able to manage these two in a way that you maintain a balance where you say moderation in inflation and at the same time you grow your economy. For the global economy, like I said, we've seen inflation in the US hit 8.3% unprecedented in decades. In the euro area, we've seen inflation hit 7.4, in UK 9%, in China to as high as 2.1, in India about 7.79%. These are price levels that are unprecedented in decades, and that is the reason the global economy, particularly the central banks or monetary policy authorities globally are thinking of that the need for them to confront inflation. And to do this means that a lot of tough decisions had to be taken. For us in Nigeria, you would have observed that in the last 2.5 years, what we have been saying is that we want to pursue a policy of price stability that is conducive to growth. And that's why somehow we have used our development finance intervention facilities, which has actually yielded positive results and helped to drive growth in our economy. We've used that to drive growth, while at the same time we'll try as much as possible to maintain a hold position while looking at the optimal level of liquidity in the industry to be able to moderate inflation at a level that does not hurt the growth and the economy of our country. But with what we have seen globally, either in the area of supply chains, in the area of increase in price of petroleum products and the rest of them, we have seen an aggressive growth in inflation in Nigeria between March and April of 2022. And the forecasts from our statisticians, both in CBN and the MBS, as well as our colleagues in research and monetary policy, is that unless something drastic, some drastic or significant actions are taken, that it may be difficult for us to really rein in inflation if we don't do something immediately. And that's the reason we felt, okay, for monetary policy, like I said, three things. One, use development finance tools to drive growth and see to how you can use those same tools through the granting of facilities at low interest rate, 5%, 10-year loan, 10-year loan with 2-year moratorium and single-digit interest rate, to see how you can use that to drive agriculture and manufacturing output to a level where it can even be seen to be positive on prices, thereby moderating prices. That is one. So what do you achieve with both that? You achieve output growth, manufacturing output and agricultural output. Through our various interventions, targeted credit facilities and SMEs, you can boost consumption expenditure and through that boost growth. But by the fact that you are boosting manufacturing and agricultural output, what you find is that we are also positively impacting prices, which also is effectively inflation. That's one approach we thought we should adopt. Another approach we're adopting all along is to seek to given the MPC give management the power to say, listen, use your discretionary power to manage the level of liquidity in the system to a point where you think that it does not hamper, create serious problems for inflation. But with what is happening globally on prices and output, and then we've seen an aggressive, a 90 basis points increase in inflation for us, and with an expectation that it may even further continue at the aggressive rise, meant that we needed to bring into the football field now MPR to further say that we need interest rates to move up, particularly in the non-priority sectors that we are looking at, that there's a need for interest rate to be signaled and a little bit more aggressive, because you would have expected that Ferraz would have done a signaling, but MPC felt that a 150 basis points would be necessary to really show that we want to truly tame inflation and rein it to a level that we think it can begin to reverse rather than continuing to go up. So what are we doing to make sure that this does not affect, because of course you will expect that lending rates will go up. Yes, lending rates will go up to the non-priority sectors. We're not going to deny that, but at least to our priority sectors where we remain committed to, MPC has told management, continue your development finance activities at single-digit interest rates for 10 years loan and 2 years moratorium, whereas what we can call the non-priority ones, if they go up, then we should be able to use that as a basis to see to how we're able to tame inflation to a level that we think is comfortable. I think what is important here is that this decision has been taken because we felt that there may continue in the next couple of months to be an aggressive acceleration in inflation. And we think there is a need to take some drastic action to reverse it. If we're able to see a reversal, perhaps we can begin to see, yeah, we're returning to what we can call the normal periods when we're looking at moderating, using CRR to moderate inflation, and at the same time, using our development finance to really push for growth. It's not an easy task, and I'm sure you can see the way I'm trying to explain it, but I think trying to understand the mindset of Monetary Policy Committee members at this time is very, very important, that we thought we needed to really speak what is true about our economy, about what is happening globally, and then see to how we can make sure that we tame inflation, which is our core mandate, and at the same time we support growth in the other direction so that Nigerians can see prosperity effectively. So I thank you for your attention. Good afternoon again.
Inflation is the buzzword in 2022 so far. Abdul Kuduza, well, this was not your prediction. You were thinking that the central bank or the MPC would still be, following growth, trying to sustain the fragile growth according to how the CBN. But I guess the CBN says, the CBN governor says, it's time for a change and follow the trend of what's happening in the world. Because according to him, he sees inflation even surging even further.
And I think that's because of the anticipated pre-election spending. It kind of featured in his remarks. That's the CBN governor's remarks. We expect a lot more spending as we head towards the polls in February 2023. So it's obviously, being very optimistic about how well the Nigerian economy can hold up. 3.11% seems to be good enough for the Monetary Policy Committee. And what I think they are looking towards is somewhat soft landing, where we will see growth slow down a bit, and then we will be able to have inflation moderate considerably. And then, as he mentioned, we could now, revert to this more centrist or dovish position. Subsequently. But I think the position is out of some, optimism about how strong the economy is. I think that's very fundamental, as well as the amount of spending we expect going forward.
From the election. I think that's a major driver. Also, let's hear what Mr. Laje. Mr. Laje, thank you for standing by all through. So, did you see this coming? I know you expected there to be a change. So, is this what you saw, the MPR up to 13%?
Well, I wasn't sure of what the numbers would be. I was thinking between 100 to 200 basis points, but it's obvious the central bank governor just mentioned 150, somewhere in the middle is what authority has settled for. But what is certain is that, like I mentioned earlier, we need to choose today between the devil and the deep blue sea. Whether the choice of the central bank governor is the devil or the deep blue sea, it's another conversation for another day. But what is certain is that having made this choice, we have to deal with growth concerns. We also have to deal with unemployment concerns. The expectation is very real. As I mentioned, food inflation has continued to show upward trend. We have also seen unbound inflation also showing an upward trend. We need to do more in terms of having revenue from having FX, I beg your pardon, from outside Nigeria, whether it is oil-driven or non-oil-driven. What is important is that we need to fight inflation and growth almost at the same time. But it's very difficult for you to win on both sides, even though many economies are losing. As growth is coming down, inflation is going up. We have seen Central Bank of Nigeria and that of Monetary Policy Committee saying, well, we need to face our own mandate right now, because there is that African saying that if you're at war and you need to protect yourself or your neighbor, it is when you're alive you can actually protect your neighbor. The core mandate of the Monetary Policy Committee, an extension of Central Bank, is price stability. That may be the reason why at this time our Monetary Policy Committee have opted to save the nation from inflation. Now, fiscal authority and trade authority need to do more in terms of protecting the nation for a fall in growth, as we have started seeing continuous positive growth within our country. So it's expected that there will be change. What I know will never happen is reduction in rate, because that would have been a disaster.
Yeah, that's obvious.
Keep rate,
we don't see that. Exactly. We obviously cannot see a reduction in rates. But, Mr. Laje, now that the MPR has been raised, and then we did hear, even as you have said, and I think it's kind of obvious, that inflation most likely is going to keep surging. Now, in the midst of the political activities in Nigeria, and then you say, okay, there's need, you know, for action in the other sector. What do you think Nigeria should be doing now, government should be doing now, the people should be doing now? Because between the devil and the deep blue sea, we are right in between. Now, MPR is higher, it's been raised to curb inflation, but we still have political spending as a major threat to that inflation. And then, of course, the after effect of raising the rates is also there. What should we be doing now to balance things out? All right, I think we've lost Mr. Laje there, so I'll just bring it to you. What do you think we should be doing at this time? Of course, so if the MPR deals with inflation, it also disturbs growth and also affects employment, you know, and other indices. How do we balance it out?
Well, I would say that in trying to stimulate growth, we need to address, you know, those structural problems we talked about earlier. We need to, you know, deal with the logistical issues, cargo clearing logistics at the ports. We need to deal with transportation. We need to deal with securities at the heart of, you know, all of this discussion. We've had vandalism of not just electricity infrastructure. Gas pipelines have got blown up. Train facilities have also rail lines have also gotten, you know, sabotaged as it were. So, you know, I think they need to the government needs to address all of these issues. Then in terms of inflation, because we are still going to see inflation. It may moderate a bit, but we are still going to see inflation because we are looking at energy costs. Now, if you look at the UK model, where they're coming up with tax cuts, and the Exchequer of the Chancellor of the Exchequer, Rishi Sunak, is looking at tax cuts. He's looking at raising, you know, what you call a windfall tax, which would help boil the position of the government to be able to, you know, support this, households,
costs,
households that are, you know, that are disadvantaged given the rising prices.
But they haven't agreed on that yet.
Yes, but it would have been nice if we could have a similar discussion in Nigeria.
Windfall tax.
Exactly, but we're not. but we don't seem to even be, you know, the oil and gas sector.
It's not even a conversation we have started in Nigeria.
Yes, the mining sector contracted by over 20% in recently released GDP figures. And that tells you that sector that ordinarily should be
even the oil sector, which is a major, you know, backbone, they also contracted. I think Mr. Laje is back. Mr. Laje, how do you think we can bring about a balance in this? Dealing with inflation now, MPR is higher, so it's going to affect growth. How do we balance things out from your perspective? Oh, I think we lost him again. So you want to finish up your thought?
Yeah, so I was saying it would really have been nice if we could, you know, come up with a waiver, a tax waiver funded by what you call a windfall tax. So a tax waiver on the part of the less privileged, of the, you know, socially disadvantaged, and then, you know, there will be a windfall tax. So in the oil and gas sector, for example, if we had, you know, that kind of, you know, profits that we expect.
But I mean, in the UK, for instance, it is easier for them to have such, and the US too, they're also talking about windfall tax. It's easier for them because it's obvious that the oil-producing companies, the corporates, are making more money.
Yes.
But we don't have there, so where would the extra tax come from?
Yeah, absolutely, and that's why we need to deal with some of those issues that represent disincentive for, you know, those oil and gas firms. There's a lot of, you know, divestment, and, you know, it's not least because there is a lot of vandalism and some of this policy instability. You know, for example, we had the PIA, the Petroleum Industry Act, which was supposed to put in place some changes within the industry. Well, the truth of the matter is that act is not being, it's not being effected as it should be as we speak.
Yeah, because we even have a stall on subsidy.
Yes.
And
exactly. So we've continued to operate within the former framework and presume that we are now in a different era.
All right. Kudus Isiaka, thank you so much for your patience. I think we have Mr. Laje. Okay, there, so I see him on the screen. So, Mr. Laje, how do you think we can balance it up? Because we just have less than a couple of minutes left.
Well, I think at this time we need all our arsenal to be at the forefront. We will not expect just monetary policy committee or Central Bank of Nigeria to start minding the economy. Ministry of Finance, Budget and National Planning must do more. Ministry of Trade and Investment must do more. All authorities as they affect the economy, including housing, all of them must come now to see how they can save Nigeria's economy for an imminent economic crisis that is ravaging the entire world and not just Nigeria. Yeah. Inflation will continue to go up. But this policy, we hope that it will tame inflation to some extent, but growth becomes a thing of concern. We need to do more very quickly with growth so that the current increase we have seen, the positive growth we have seen 5 consecutive times, will not start seeing reversal of growth. Okay. And you know that there has been a projection earlier in the year or late last year by International Bank, I think IMF or World Bank, saying that Nigeria may go back to pre-COVID growth, which of course was lower than population growth rate. So we have a lot to deal with, especially as it has to do with dwindling revenue that government is making, and more importantly, the effects we are getting from outside Nigeria is also a thing of concern. So authorities, the managers of the economy, this is the time for them to come on board and see how we can go beyond the average work to ensure performance. Now that the rates are high, it means that performance of the economy, it means rather that unemployment may go a bit higher and growth may come down in a medium term. And that could be 6 months, it could be 1 year, but this is what is expected while we try to manage inflation.
All right, Mr. Paul Alaje, Senior Economist and Partner at SPM Professionals, thank you so much for taking some time out to join us on the program. And here in the studio, Kudus Isiaka, economist with ProShare. Thank you so much for joining us on this MPC Decision Day. And so we've had started at 11, and now we have to go, but MPR is now at 13%. It went up by 150 basis points, went from 11.5%, where it's been for over 2 years since September 2020, and now it's now at 13%. And the reason for this is to tame inflation, which, according to the CBN's observation, is going to keep surging with the realities of our time. Recovery from COVID, which is still there, and the after effect of the war. Please do remember, for our DSTV viewers here on Channels Television, Political Paradigm is coming up on the top of the hour, and the guests that Terry has is Governor Kaide Fayemi. You have an interesting conversation coming up there, while for our terrestrial viewers, the news, you'll be missing that every hour for hours now. So the news will be coming up to our terrestrial viewers, and then Political Paradigm is up next. Thank you so much for being a part of this special edition of the MPC Decision Day here in Nigeria. We'll continue this conversation and find out how we can get that growth that is a threat in the face of a hike in the MPR. We'll do that subsequently here on Channels Television. I'm Ini John Mekwa. Thank you so much for being a part of this.